Okay, good. All right, so all right, so this is chapter 15, Introduction to Managerial Accounting. Let's see. Oh, I need to show you my screen. Or can y'all follow along?
The PowerPoint.
Yeah.
Yeah.
Is everybody able to do that? Okay. All right, so managerial accounting, also known as management accounting, and it's differentiated from financial accounting because, as we just studied in financial accounting, we learn how to prepare financial statements for external use. So for borrowing money from outside, for soliciting investors, to reporting to investors, reporting to the government. So external reporting is financial accounting. Managerial accounting, the word manager, provides internal type reports for managers, for internal use, for studying costs and revenues, mostly costs, because that's something that managers can't control. So we produce internal reports that managers can use to make better internal decision makings instead of external decision making. Okay, so that's managerial accounting. That's what we're studying in 331, cost accounting. All right, so I'm going to skip a lot of this stuff. All right, so let's jump over to manufacturing operations. And we talked a little bit about this in the last class. So in this, the company is manufacturing guitars. Okay, manufacturing guitars. All right, and we talked about this a little bit already. So a cost, there's what a cost is. A cost object is we assign the cost to some particular object. There's direct costs and indirect costs. Direct costs can be traced directly to a cost object. So we talked about direct materials and direct labor. Those are direct costs versus indirect costs. Indirect cannot be traced directly to an object. So we have to allocate those. Okay, so here's direct. So in making guitars, if the cost is traceable to the product that we're producing, then it is a direct cost. If it can't be traced directly to the product that we produce, then it's considered an indirect cost, and it must be allocated to all products that we produce. So like in the guitar, it's got to be an integral, integral, an integral part, a big enough part that we can trace it. Okay, so the wood, the frets, the strings, that's a traceable part of a guitar. All those parts are integral, important, more expensive parts. Well, what we use to shine the guitar with, what we use to work on the equipment that makes the guitar, those are indirect costs. We cannot directly relate that to a particular guitar that we've made. Okay, so that's the difference between direct cost and indirect cost. We also have direct material. Or direct labor rather. So direct materials is anything that becomes an integral part of the product. Direct labor is anybody who actually touched the product. Okay, they are a part of cutting out, manufacturing, fabricating the product. So you have some people who are direct labor that work in the factory, and others that are indirect labor. And we gave examples yesterday. Who can remember an example of indirect labor? Janitors. Yeah, they work in the factory, they clean the building, they maybe clean the equipment. The guys and gals that work on the equipment to keep it in good working order, they don't manufacture product, but yet they work in the factory. What about the supervisor? Supervisors generally do not work in production. They supervise employees and resources, right? So they work in the factory, but they're not direct labor because they don't manufacture. Okay. So that's indirect labor. And of course, in manufacturing, we only have three costs. Every cost in the factory, anytime we have to expend money, it's either going to be a direct material, a direct labor, or it's a part of factory overhead. Okay. Everything's going to be classified in one of those three categories. So there's direct materials, there's direct labor, and here's manufacturing or the manufacturing overhead. So the overhead of manufacturing is going to be everything that it costs us to run that factory besides direct materials and direct labor. So the utilities, heating and lighting the factory, repairing, maintaining the equipment, property taxes on the building, the land, the equipment. If you're leasing whether you're leasing the equipment or whether you own the equipment in the state of Kentucky, we have to pay property taxes on everything that we use in business. My computer equipment, my desk, I have to pay property taxes on that crap every year to the state of Kentucky. Okay. Anyway, so if I become governor, I'm fixing that. Anyway, all right. So property tax, insurance on the building, insurance on the equipment. You can't relate that to a particular product, right? So if you're making guitars, can't relate the insurance on the building or the property taxes on the building or even the utility bill to a particular guitar. So that's why it has to be part of overhead. Overhead's going to get allocated. It can't be directly related to a product. Okay. So depreciation on the factory, plant, and equipment. So of course the factory is the building, and then equipment is all the equipment inside the building. All right, then we have prime cost versus conversion cost. Our prime cost are our directs. Direct materials and direct labor are called prime cost. They can be related directly. And then your conversion cost, the definition is whatever it takes to convert materials into finished product. So your direct labor and manufacturing overhead are your conversion costs. So that's just a couple of definitions that you need to know. All right. Product cost versus period cost. In a factory, actually in the system, remember I drew that wonderful picture that I drew for you last class where I had the storeroom, the factory, and the warehouse. All of that entire system is manufacturing. Everything in those three buildings or these three locations are all product costs. We have no expenses in that system. What's an expense? The using up of an asset, right? What are we doing in those three buildings? We're producing an asset. So there's no expenses in there. Every cost is inventory. Does that make sense? Because what are the accounts? The first building is raw materials, right? Or materials. That's an asset account. It's an inventory account. What's in the factory? Work in progress or in process. Okay. That's an asset account. It's inventory. What about the last building? Finished goods. They're all inventory. There are no expenses. So you cannot let yourself make an expense in that whole system. Okay. That's all just a part of inventory. Now, cost of goods sold is the end. It's an expense account. So when you exit that system, when the product exits, then it becomes an expense because that means that the inventory has been sold. So remember, that's what cost of goods sold is. It's the cost of the goods that we sold. The goods are the inventory. So when we exit the system, that's cost of goods sold, which is an expense. Everything else is an inventory item. Okay. All right. The alternative are period costs. Now, period costs are expenses. So that's going to be like your selling expenses. Your salespeople, they may have their own building, their own equipment, their own supplies that they have to buy. Advertising, freight out, these are all selling expenses. So that's after the item has been manufactured. This is the cost of selling the product, and that is a period cost. It's an expense. Administrative expenses, all the suits, okay? The CEO, the CFO, all the people over there that wear pantyhose and suits, those, they don't work for a living, right? It's the factory people that work. Okay, so all the administrative costs, those are period costs. Those are expenses. So all the administrative salaries, the cost of all their equipment, the cost of operating their building, that's all period costs. Those are expenses. Okay. So you need to be able to differentiate between the two. Product cost is everything. It's in the manufacturing process. Period cost is in those other buildings, the sales building and the administrative building. Those are actually expenses. Okay. Okay. Financial statements for a manufacturing business. And we studied this. If you have my 270 class, we did for service businesses and we also did for manufacturing businesses. Big difference. If we're a merchandiser, we only have one inventory account, right? What's inventory? Everything the company owns that is available for sale in the ordinary course of business. That's what inventory is. If I'm a merchandiser like Walmart, okay, I buy crap from all over around the world wherever I can find it cheapest, right? Stock it on the shelves. It's available for sale. That's inventory for a merchandiser. If I'm a manufacturer, I'm buying what? Raw materials, bringing it into the factory, applying direct labor and factory overhead, and turning it into a finished product. So in a merchandiser, I only have one inventory account because I'm simply buying inventory and selling it. So it goes straight from inventory to cost of goods. But if I'm a manufacturer, I buy it, it starts out in materials inventory, flows through to the factory, which is work in process, and then flows to finished goods when it's ready to be sold. And then it exits to cost of goods sold. Okay. All right, there's what it looks like. There's your merchandiser. So Legend Guitars builds the guitars, sells it to Musicland Store, who sells it to the consumer. So you have a manufacturer and a retailer. Does that make sense? What's a retailer do? They sell at retail to consumers. A manufacturer sells at wholesale to a retailer. Good. All right. And then on the income statement, we have a difference as well. So it's important that we keep up with cost of goods sold if we're selling stuff. That's an important number. And gross profit. So if you're a retail business, you have slight difference, right? So you have goods available, inventory available for sale, cost of goods manufactured, because we're a manufacturer, so we have a separate line item there, cost of goods manufactured. Whereas in a retail business, we don't manufacture, we simply buy, mark it up, and sell it at a profit. Okay, so a slight difference there, but still calculating cost of goods sold.
So
Still,
cost of goods manufactured is basically substituted for expenses on here.
it's not expenses. Remember, there's no expense in the manufacturing process. It's
So
only
it's just the cost of manufacturing. So, it's gonna be, it's not a negative, but it's always a cost. You know what I'm saying?
well, cost of goods manufactured is equivalent to finished goods. The cost of the goods that we manufactured. So the cost of goods manufactured is finished goods. Remember, when it exits the factory, that's cost of goods manufactured, goes into the warehouse available for sale. So it is the finished goods, the cost of the goods that we manufactured or finished. It'll come. Okay, but when the cost, so if we're a retailer, it goes straight from inventory to cost of goods sold. If we're a merchandiser, it has to get over to finished goods in order to be cost of goods sold. Okay. All right, so there's cost of goods manufactured. All right, so here's what the income statement looks like. So there's your formula for cost of goods sold, right? Beginning inventory plus cost of goods manufactured minus ending finished goods inventory equals cost of goods sold. Remember, we did those formulas. And there's a statement of cost of goods manufactured. And that's got the all three formulas on it. Okay. So notice, remember when we did the first location? Okay, so we had the storeroom, the factory, and the warehouse. Okay, we purchase raw materials from the outside world. Okay, in order to calculate direct materials used, okay, direct materials on the cost of goods manufactured, cost direct materials used, how do we calculate it? Beginning materials inventory plus purchases are input, right? What's the rest of it? Minus ending materials inventory equals direct materials used. Remember that? We had some stuff in here. We bought some more. We calculate what's left at the end of the month. Whatever left is direct materials used, which goes into the factory. Once we get the materials into the factory, we apply direct labor and factory overhead into the factory. That's our three manufacturing costs: direct labor, direct materials, and factory overhead. And then we can calculate cost of goods manufactured. What's the formula for cost of goods manufactured? Beginning work in process, right? And work in process is everything that's in the factory. If it's not in process, if it's already finished, got to get it out of there, right? Got to keep the factory efficient. So you only bring it in as you use it. As long as it's in the factory, it's work in process. When it's finished, it goes to the warehouse. Okay. So beginning work in process plus our three manufacturing costs. So direct labor, direct materials, and factory overhead minus ending work in process equals what?
Cost of goods.
Cost of goods manufactured. Good. Then cost of goods manufactured flows into the warehouse. And of course, the warehouse is finished goods. So in order to calculate, what's this?
Sold goods.
Sold. Okay. So this is cost of goods sold. How do we calculate cost of goods sold? Beginning finished goods inventory plus, what's our input?
Cost of goods.
Cost of goods manufactured minus
Into finished goods.
ending finished goods inventory equals cost of goods sold. Okay. So if you looked at this cost statement of cost of goods manufactured, you're using all three of those formulas. So you have to go inside. So you're starting with work in process, beginning work in process, which is in the factory. And then you calculate your cost of direct materials used. You add your direct labor and your manufacturing overhead. That's your three manufacturing costs for the period. And that gives you total manufacturing cost incurred. Add that to work in process, subtract ending work in process equals cost of goods manufactured. Okay, so beginning work in process plus direct labor, direct materials, and factory overhead equals manufacturing cost, total manufacturing cost, subtract ending work in process equals cost of goods manufactured. So if you know the formula, you can fill out the form.
Right,
So-
so that's purchases, that's a purchases right on for the direct materials used. Right there. That's in-
Beginning materials plus purchases minus ending materials inventory equals direct materials used.
This video is gonna be on.
Yes.
Okay.
Okay, good. And of course, we'll go through it again. You know, this is giving you something to chew on. All right. And here's a nice little picture that shows you the same thing. So I like my picture better because I draw that truck. It's so beautiful, right? So you buy materials, bring it in. So on the balance sheet, how's it represented? Materials goes into materials inventory. Everything in the factory is in work in process inventory. So you bring your indirect materials goes into manufacturing overhead because remember, they can't be allocated directly. So we have to put those into overhead and then we're going to allocate them into the factory, into the other products. Okay, so we're going to learn several procedures on how to allocate factory overhead. So in the factory, we bring in our direct materials, we bring in our labor, and we bring in our factory overhead to calculate our total manufacturing cost for the period. And then we calculate cost of goods manufactured. You take beginning materials inventory plus all your costs coming in, subtract ending material or work in process inventory, and that gives you cost of goods manufactured going into finished goods inventory, and then of course we calculate cost of goods sold by calculating beginning finished goods plus cost of goods manufactured minus ending finished goods equal cost of goods sold. So you just got to know those three formulas, but they make sense, right? You use the same formula 3 different times, and it makes sense. You had some stuff, you brought some more stuff in, whatever's left you subtract, and then that tells you what left that particular location. All right, so so if we were doing a motel, we can calculate occupancy rate, and I think we have a few questions on that. So your occupancy rate for a motel, and they can use cost accounting as well, even though they're not manufacturing a product, they're actually offering a service, right? Motels do. So your number of guest nights, the number of guests that spent the night with you divided by your total available rooms is your occupancy rate. I think we have a few questions on that. And here's some other types of industry, service industries. So utilities, electric power generation, there's an example of the type of company. Transportation, so FedEx transports goods. Information, social media, so there's an example, meta platforms. Okay, so different industries, even service industries, can use cost accounting. So I remember in one of my lives, I worked for the Fork Empire, and he owned 7 nursing homes at the time. So we would calculate the cost per patient day in every department. So how much did it cost per patient day for a nurse's time, for a radiologist's time, for a dietitian's time, for a nurse's aide? So we calculate cost. We used cost accounting methods to allocate cost. How much did it cost per patient day to have a janitor? Okay. So even though it's a service business, you're providing healthcare services, you can still use cost accounting to allocate cost to see, and what's the purpose of it? To look for inefficiencies, right? So if you wanted to see how to make the most money, you find somebody that's making more than you and see how they're doing it. How are they doing it? They're either increasing revenue or lowering cost. So if you can drill down and calculate your cost per patient day in every department throughout the facility, if you're spending more in a department than somebody else is, you might be able to find an inefficiency. Okay, does that make sense? So we're learning how to drill down and get the most out of accounting information in order to make operational type decisions, not just financial decisions. That's why we study cost accounting. Said all that. Okay, that's chapter 1. Or chapter 15, I should say. We start in 15 in this class. All right, so let's look at, let me stop the recording there.